Hello, and welcome to Explain the Charts, your go-to channel for in-depth technical analysis. Today is October 19th, 2025, and we're seeing a sea of red across the cryptocurrency markets, with Bitcoin at the epicenter of the storm. In today's video, we'll first cover the dramatic news events that have sent shockwaves through the market. Then, we will dive deep into the BTCUSD charts to identify key levels and discuss what could happen next. The headlines are brutal. Forbes is calling it a free fall that has wiped $600 billion from the crypto market. Prices have plunged from an all-time high near $126,000 just a couple of weeks ago to below $105,000. The Crypto Fear and Greed Index has dropped to 32, firmly in fear territory, reflecting widespread panic among investors. Several factors are being blamed for this crash, including renewed fears of a U.S.-China trade war, anxieties in the U.S. regional banking sector, and a historic liquidation event that squeezed over 1.6 million traders. Adding to the bearish sentiment, we've seen massive outflows from spot Bitcoin ETFs, with over $500 million pulled in a single day, reversing a strong trend of institutional inflows. While Bitcoin's reputation as digital gold is being tested, with actual gold surging to new highs, some positive news has emerged around new DeFi mechanisms and institutional adoption, though it has been overshadowed by the sell-off. Now, let's turn to the charts to see how this story is unfolding in the price action. Looking at the daily chart, we can clearly see the parabolic run-up that took us to the all-time high of $126,296 on October 6th. That peak marked a powerful rejection, and since then, the trend has sharply reversed. The first major sign of trouble was the flash crash on October 10th, where we saw a massive red candle with a long lower wick, dropping the price all the way down to a low of $103,310 before closing higher. This candle reflects the massive liquidation event reported in the news, indicating extreme volatility and a huge battle between buyers and sellers. After a brief attempt to recover, the selling pressure resumed, and we broke below the key support area around $110,000. This $110,000 level, which previously acted as support in late September, has now likely flipped to become a new resistance level to watch on any bounce. The price then made another significant leg down on October 17th, falling to a low of around $103,500. This retest of the October 10th low establishes a critical support zone between $103,000 and $105,000. For 2 days now, the price has been consolidating in a tight range, suggesting the market is pausing to digest the recent losses and decide on its next move. Let's zoom in on this recent price action to get a clearer picture of the reversal. Here on the daily chart, looking from the start of October, you can see the final push to the all-time high, followed by the complete breakdown of the uptrend. The strong, high-volume red candles on the 10th and 17th are classic signs of distribution and institutional selling. The recovery attempts have been weak and on lower volume, which is a bearish signal. We are now trading well below what would have been the short-term upward trend line. The immediate challenge for bulls is to stop the series of lower highs and lower lows. A daily close below the $103,500 support level would open the door for a much deeper correction. Conversely, bulls need to see a strong pushback above the $108,000 level to show any signs of life. Switching over to the 1-hour chart, we can analyze the short-term trend in more detail. This chart clearly shows the downtrend established since the October 10th crash. We can draw a descending trend line connecting the highs, which has been acting as dynamic resistance. Recent attempts to rally have been decisively rejected, for instance at the $112,000 and more recently the $109,500 levels. The price is currently consolidating in a tight range, which often precedes a significant move. The immediate resistance on this time frame is the top of this range, around $107,700. The immediate support is the bottom of the range, near $106,300. A break of this range will likely dictate the direction for the next 24 to 48 hours. Now, for the very short-term picture, let's look at the 15-minute chart for the last day or so. Here we can see the choppy, sideways action very clearly. The price has been oscillating between roughly $106,400 and $107,700. This indicates a temporary equilibrium between buyers and sellers after the major sell-off. Volume has been relatively low, which is typical for a consolidation period, especially over a weekend. For day traders, this is a clear range to play. A convincing break and hold above $107,700 could trigger a short squeeze towards the next resistance at $108,500. However, a break below the support at $106,400 would signal a continuation of the downtrend, with sellers likely targeting the major daily support at $105,000 and below. Traders should be cautious of fakeouts, where the price briefly breaks the range only to reverse quickly. So, to recap and bring it all together, let's go back to the daily chart. The market sentiment is deeply bearish, backed by concerning news and a clear technical breakdown from all-time highs. The key price levels to watch are critical right now. Immediate support is the zone between $103,500 and $105,000. If that breaks, the major psychological level of $100,000 comes into play. Below that, we're looking at potential targets in the $90,000s or even the $85,000 area, which aligns with some analyst predictions. On the upside, immediate resistance is at $108,000, followed by the more significant barrier at $110,000. Only a sustained move back above $112,000 would begin to challenge the current bearish narrative. Now for some potential scenarios. The bearish continuation seems more probable in the short term, with about a 65% likelihood, given the trend, momentum, and negative macro environment. A break below $106,000 in the coming hours would reinforce this view, likely leading to a test of the $103,500 low and potentially the $100,000 mark. A bullish reversal or relief rally has a lower probability, perhaps around 35%. For this to happen, we would need to see buyers step in with force to break and hold above the $108,000 resistance level. Positive news on the macro front or a sudden spike in ETF inflows could be the catalyst for such a move. Long-term, this could be the healthy, albeit painful, correction the market needed before its next major leg up. However, if support around $85,000 were to fail, the bear market scenario with targets as low as $52,000, as mentioned by one trader, becomes a serious possibility. Keep a close eye on ETF flow data and any headlines related to the US-China trade situation and banking stability. These factors will likely be the primary drivers of Bitcoin's next major move. And finally, a quick disclaimer. Please remember that this analysis is for informational and educational purposes only and should not be considered financial advice. The cryptocurrency market is extremely volatile and carries a high degree of risk. Always conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you in the next one.